The Iran war immediately sent bond yields higher with the higher price of oil and the threat of inflation. We've now entered the 5th month of the Iran conflict, and it's time to talk about a long-range consequence that nobody else is really mentioning. I'm Jason Kish, I'm in the commercial real estate investing space, and I'm going to walk through how this war is making housing affordability worse in the short term, but how it's going to also create a completely separate issue that'll negatively impact housing affordability out into the future. Make sure you stick around for the whole video, because I'm going to lay out a few pieces before I tie them all together. It really is a compelling case when you view it holistically. Everyone feels it. This conflict has already made our lives way more expensive. Gas and commuting costs are up, so is air travel, the cost of everything that's shipped via trucks, ships, planes, even trains, because yes, those things run on diesel too. I actually made a video a few months ago that was talking about all the ways that the increases of fuel prices will impact products. And yes, all of that ended up coming true. Because we've been in this conflict for a sustained amount of time, now those price increases have set in. So these cost increases were supposed to be short-lived, but we're 5 months in and bond yields have moved sharply higher. The 10-year Treasury yield is the biggest factor for mortgage rates and most loans in general. So much is based off of the 10-year Treasury. High Treasury yields, especially the 10-year Treasury, that's a big drag on home prices, but it's also raising payments at the same time, so it's increasing the unaffordability while it's slowing down the housing market right now. Like I was just mentioning, the higher bond yields, especially the 10-year Treasury, it does have a tendency to slow down the housing market. So I have a little bit of data from CNBC here. This is just showing the 10-year Treasury over the last 10 years. And you can see that, it had a very serious trough. This is where a lot of people bought houses back here in 2020, 2021. And since then, the interest rates have gone way up. They really have gone up as a reaction mostly to inflation, but there are a couple other factors as well. So the other thing to note is that even when the Fed drops rates, it doesn't necessarily control the 10-year Treasury. Actually, it appears most of the time that the Fed acts in reaction to the 10-year Treasury. So these bonds can't just be changed with Kevin Warsh coming out and saying that he's going to lower interest rates. That's not really how the 10-year Treasury works. With the rising inflation from this conflict, it's going to be really hard to battle these bond yields lower. Regardless of what other people are saying on the internet, there still is a shortage of houses in America. And I want to just show you a little article from Goldman Sachs that they put out. Their concern here really is the outlook for US housing supply and affordability, because those two things go hand in hand. The shorter the supply, the worse the affordability is. So in this article, they go through how the US affordability has declined sharply, especially after the pandemic. And a lot of that has to do with the higher interest rates. They think that there needs to be about 3 to 4 million additional houses built on top of what our normal construction is right now. There's a shortage of homes, and those homes' prices are being held down somewhat by interest rates because people simply can't afford the payment, because that higher interest rate causes the payment to go up for the same priced home. Those high interest rates, they also negatively impact the builders, because the builders have to borrow money to build the houses, so it slows down their building. So what you have here now is you have more costly building and borrowing, and people are willing to pay the same or maybe less money, depending on the market that you're in, for those houses. So really low interest rates support more construction, which is what we need, and high interest rates generally tamp down the construction. Let's look at the new privately owned housing starts. This is according to Fred, which is the St. Louis Fed. You can see back in 2016, 10 years ago, we had a shortage of homes being built at that time. And there is a structural shortage, and it has a lot to do with labor and costs and those sorts of things. But there are also some other governmental policies that can also contribute to shortages. So we started to pick up our home building going into 2020, but then obviously that took a sharp dive during the pandemic, and then it came back, and you can see when interest rates were lowered, the starts went way up. So the lower interest rates caused lower prices for the builders, so they were able to build more units, and this should get us to cover some of that gap in the shortage. After inflation set in and the bond yields went up, which you can see in this chart exactly when the bond yields went up, it made it harder to build those houses because of the borrowing costs. Look how you can see this immediate reaction when interest went way up in 2022, when the inflation went way up and carried the interest rates up with it because it brought bond yields up, and because the Fed had to follow and raise their rates as well. You can see that the new starts plummeted immediately, and they've been held down by that higher interest since. If you were wondering just how tightly correlated the 10-year Treasury yield is, and again, that goes into mortgages and the loans that these builders take out. If you were wondering how tightly that's correlated with the new housing starts, just look how these inversely impact each other. So you have low starts here, that's during a high interest rate period. Then you have the high starts here while there's a low interest rate period. And then there's a little bit of a lag. As the interest rates go up, it then makes that cut. And you can see the plateau of higher interest where we've been since 2020. It's caused this valley in the new home starts. So this higher interest rate environment is keeping the house prices from growing the way that they probably would if interest rates were lower, but it's also pushing up the costs for the builders, which is forcing them to abandon their plans to build more. You can see where this is going. The shortage will become worse, and it'll drive the prices even higher. So that's that long-term impact that I was talking about at the beginning of this. In multifamily real estate, the cheap money era of 2020 through 2022 created oversupply and pushed down rents. This is not a normal thing to happen for a couple years in a row. So those rents now can't support the new building, which is creating another round of undersupply, because there's a 3-year lag from permit to having renters actually in the building. So what I predict is going to happen is those rents have to go up. They normally go up with inflation, that's a normal thing. But also when you think about putting together those buildings, the concrete is going up, the wood is going up, the labor is going up. All the expenses that go into those buildings are going up. I think that's going to bring the value of those buildings up, and it's going to bring rents up with it, because that's the only way that you can actually build new properties, is by bringing rents to the point where those new projects will make sense. I'm no stranger to Reddit and YouTube comments, so I know a lot of people will be thinking houses have to come down 50% because nobody can afford them. Houses could crash by 50% in the short term because anything can happen in the market. The short term's very unpredictable. But the reality is that houses don't care how expensive they are. A shortage is a shortage, and people will prioritize shelter over just about everything else. By the way, if a crisis drives the prices of homes down 50%, will the government cut rates and print more money to get out of the crisis like they've done in every single crisis in my lifetime? If they go that route, that'll increase the money supply and it'll boost home prices further in the long run. Am I saying that you should run out and buy a house or buy an apartment building today? No, it's never a good idea to rush into any kind of investment, especially a big one like that. If you're renting right now and you're saving money, that can be a great short-term plan. Please just do yourself a favor and invest everything that you possibly can while you're young. Inflation will be a major issue throughout your whole life, so find out how to beat it and stick to your plan. I hope I'm not coming across as being preachy. I'm passionate about creating a passive investment portfolio that works 24/7 so that I can spend more time with my family. I want to share information that I'm seeing in the real estate and in the investing space because I want you to be able to live life on your own terms, and a big piece of that is financial freedom. I hope you enjoyed this video, and if you agree or disagree with some of my points, I'd love to hear from you in the comments. Please like and subscribe because it helps the channel immensely. I'll see you on the next one.